I'm super excited about this panel, and the panelists is really happy that they agreed, not at gunpoint, to come and dispense some wisdom with you guys. So I'll start with just some introductions. So Michael Geldart is the person on the far end. Mike's a partner at Excellere Partners, and he started his career as an attorney with Holland and Knight, and then moved into several successful roles as a COO at CCS Medical, MedExpress, Urgent Care, and most recently Biotelemetry. Mike's a pretty humble guy. I've gotten to know him well this year. He's the humble guy in the room that has seen and fixed more operating challenges than almost anybody. He's also the PE guy that's the anti-PE guy. He rolls up his sleeves and really works hard. So I'm really thankful, Mike, for you joining the panel. And not to come in second, the next PE guy we have, Ron Geraty. Ron's an operating partner with Varsity Healthcare Partners. He's the chairman of Aduro, past CEO of Excellere, Derm One, and Access Point Health, so he's seen a few things. He's been a board member of a variety of healthcare companies, and Ron is, in my opinion, always the voice of reason in the room. He's that guy that doesn't say anything until the end, and then he says it, and everybody's like, oh, he's right. So he brings a ton of financial and operational horsepower to the table with companies he works with, and I definitely count myself fortunate to have worked with Ron this year. And then Warren Gouk is an old friend. He's a partner of mine from Cascadia Capital of 10 years. And then Warren left the dark side. It was amazing. He went back to the light. And he now he first went from Cascadia to be SVP and GM of LexisNexis. And then he followed taking on the role of Limeade. And then finally is now the CFO of LifeStance Health. And Warren, I think, brings this really unique perspective on transactions, the climate, the value of private equity, how to ensure your business is positioned right. And Warren is again, a good close friend, and thank you for coming today.
Thanks, Kevin.
So with that, we have kind of 4 different sections that we're going to go through, and I'm hoping we're going to do a high degree of difficulty here in terms of the dive that we're hoping to do. We've got 2 PE guys and 2 deal guys, and we're going to try to be transparent with you and tell you what actually goes on in our minds. So the degree of difficulty is going to be a 9.5, I think, on that. We're going to go through deal dynamics, market dynamics, a view from the inside, and post-transaction. And so, you know, this is going to draft a little bit off of some of the stuff I saw in the last panel, but right now we are in an unprecedented time of capital flowing in to the markets and into digital health. In 2013, it was $2.9 billion. This year, we're estimated to be at $14 billion. Pretty good hike. So, you know, Mike, I'm going to start with you and just ask you what you think is really driving the increase, and is it sustainable?
So, you know, my crystal ball is probably no better than anybody else's. In terms of sustainability, I think we look at the market, anything else, all of our traditional notions of sustainability in terms of valuations are probably long gone. So is it sustainable? I think it's sustainable for as long as it stops being sustainable. What I do think is driving it is, I do think healthcare today is going through one of those transformational redesigns from what it has been in the past. And that is the power level is shifting between the providers and the payers and the patients. For the first time with higher and higher deductibles, we're seeing patients becoming much more, and patients including myself, consumerized. But we're now looking at the cost. We're looking at the experience. We're expecting a more retail experience. I remember when I ran urgent care, one of the comments we'd oftentimes think about it is, why is it I can go into McDonald's or into a grocery store and get better customer service spending $20, $30 than when I walk to my doctor's office and I spend $150? Shouldn't the demand, shouldn't the expectation for the experience be the same? I think the generation of healthcare purchase today is changing. And that's being responded to by you're seeing more efficiency being driven in healthcare, more use of technology to make healthcare more effective and more accessible. When I say accessible, I mean ability to access it at different times. And patients, because of information available, are becoming more demanding to become part of their healthcare. And all of that, I think, is generating this sort of transformational picture of healthcare where consumerization, access to information, and effectiveness starts becoming demanded by the consumers more than it has in the past.
So Ron, Varsity Healthcare is one of the most active private equity funds in healthcare. It's all you guys do. What's the banter in the partnership? What are you guys saying about what's happening in terms of the increase of capital coming in and prices and deal dynamics and things like that?
Yeah, you know, I would say it's one of the things that we really, really struggle with, because we've been in healthcare for a while and we're watching multiples go up. And I would say the multiples and by multiples, I mean the multiple on earnings of the companies is really what we price our deals on. And they've really gone from high single digits, middle single digits, high single digits now into, you know, the low teens. And we don't think that that's really sustainable, but there really is far more money to invest in healthcare. And I think money's coming into healthcare. It's 20% of the economy. You know, a lot of private equity companies out there sitting on billions of dollars to invest that they haven't invested. They're beginning to focus on healthcare because of the changes that are happening in healthcare that Mike talked about. They're new to healthcare, and so we call them dumb money.
We call them tourists. Yeah.
You know, so you know, they're
find a
coming
good
in
tourist out there.
They're willing to pay high multiples for businesses that we think are not sustainable in terms of those multiples. Now, the businesses are sustainable, but the multiples aren't sustainable. So we're actually, you know, very worried about the current market dynamics. I would say this is a fabulous time to raise money. It's a fabulous time to sell. It's a really difficult time to invest wisely. And so yeah, that's what I'd say in terms of deal dynamics that we think about.
There you have it. It's a good time to be an investment banker. I'll tell you guys all that. So Warren, I'm going to skip to you with the next question. We talked about a little bit with all this capital coming in. You know, you have to think about the M&A environment and what's happening with that and what's driving it. And I know you've looked at a lot of companies, and before you ever even talk to a company, you think about, it's a funny thing you do, you think about their exit. Talk to the audience about what you see happening in M&A and some of the trends, the things to look for, and then the pitfalls in this environment of wacky capital coming into healthcare.
Got it. You got it, Kevin. So healthcare, very, very large market, $3 trillion. There's tons and tons of capital flowing in, I think 14 billion in just the digital health and more innovative areas. And you have a lot of new entrants that are coming in. They're trying to do different things. You have a lot of investment as it flows in. There's a certainty around that. They need to look for exits at some point. They don't have indefinite hold patterns. You have large strategic consolidators that are also looking at how they continue to be relevant as the healthcare markets change. And they've been stuck in their ways of doing things for a long time, and they don't necessarily represent innovation at its best. So there's a lot of opportunities when you look at the buyer landscape. From a former investment banker point of view, and I won't go through the Michael Douglas Wall Street story of the speech, but you can think about M&A as it's kind of either driven by fear or greed. And on the fear side, you have the payers, and they're worried about disintermediation. They're worried about the consolidation that's going on. So there's a lot of things that are driving them. They've been in a fat cat syndrome for a long time, sitting on lots of capital, but haven't really deployed it effectively. So they're now looking at ways where they, from a fear standpoint, can drive into acquisition and achieve innovation, market share expansion, and also look at different areas of cost takeouts. Then on the other side, you have greed. And I think that's largely driven by the inflow of massive capital into the category and a lot of the private equity firms that represent great innovation and growth opportunities. So you're seeing multi-billion-dollar funds make huge bets, taking big public companies private, like Change Healthcare had done and then reemerged. There's a lot of big public companies.
Athena last week.
What's that?
Athena last week.
Yeah. So there's a lot of potential opportunities where private equity firms are looking for ways to innovate, ways to accumulate market share, ways to improve the workflow and drive more innovation in that area that I think will continue to create a lot of M&A activity. I think this year it was in the $300 billion mark across all of healthcare. So that is generally kind of in line with the last few years. I expect the M&A activity to continue to be very, very robust, but I also share the views of valuations starting to reach highs, and I think you're going to start to see a little bit of a reset around those valuations.
Yeah, but is there enough market cap in the public companies right now that are in healthcare to sustain a lot of M&A? I would contend there isn't. And we're going to need companies that are not in healthcare to come in and fuel some of the exits for some of these unicorns and whales that have been funded over the last year. What do you guys think about that?
I think you're going to have to, from the perspective that it's going to drive the innovation. Part of what I think slows down innovation and disruption in healthcare is healthcare tends to be rather slow moving. It tends to be resistant to innovation. It tends to be rather resistant even to technology advances. And outside companies are coming in, are going to force some of those changes. Now, some of those changes are because of sort of the antiquated regulatory structure we're focused and we have to deal with, and this sort of 50 flavors of regulation that you have to deal with if you're a national healthcare provider. But I think those larger companies that have been innovative, have been disruptive, moving into healthcare are going to force the changes that really the healthcare process and the healthcare industry need to have occur.
I actually think one of the most exciting developments in healthcare is the excitement that several of the consumer companies have about healthcare. You know, whether it's Apple or Google or Amazon, you know, Microsoft. Microsoft's not really a consumer company, but I mean it is in many ways. But I think they're all getting very excited about all of the cash flow and investment happening in healthcare. And I think I think disruption is driven by the small entrepreneurial companies that are happening, but I think the piling on and the opportunities are really going to even be accelerated by some of these consumer companies' interest in.
Well, Ron,
in
you and your
healthcare.
brethren are going to need that excitement because you're going to need returns out of all the investments you guys are making. So, and you're going to need somebody with a pocketbook to be able to make it happen.
I'm trying to stimulate that.
Yep, I don't think you're going to see the market caps of the public digital health companies really take out some of these big whales, which is the next question for us. And it doesn't have to be one of these companies, but I came across, I'm a list person, so I came across this list of the biggest deals over last year, just for those of you that want to know. Peloton, Oscar, Grail, 23andMe, American Well, Butterfly, Heartflow, and Helix. What's your favorite whale? Pick your favorite child, Ron. Which one do you like the most?
Well, you know, I actually think the payer industry needs to be completely changed. So I like Oscar. I like Devoted Health. You know, I like those companies who are coming in and radically transforming the payer world to be much more consumer oriented. You know, I was thinking about your comments. By the way, if you're only paying $150 to your doctor, I want to find your doctor because I have to pay a lot more than. But you know, one of the things that I would say is it's got to transform the way business is being done. EOBs are one of the most complex, opaque tools that most of the payers currently use. And I spend time, whether it's with my kids or my family members or friends, trying to explain an EOB is not a bill, but trying to explain what it means. And I have to say it's opaque to me much of the time.
Yeah,
so
it's crazy.
It's just not a consumer-friendly industry.
And Warren, you had a company you like.
Yeah, maybe to just piggyback off of the EOB complexity, there's a lot of really interesting companies out there. I do think Oscar is very interesting in trying to create the Amazon in-a-box experience where you can get healthcare from zero to complete in 3 clicks and in less than 5 minutes is kind of a neat concept that they are executing well on. The company that's in my backyard up in Seattle is called Accolade. And Accolade has been around for a long, long time. It started out as a call center business in the Philadelphia area, and they wanted to try and remove the complexities of healthcare. And they wanted to act as an enterprise service for large corporations that had employees that really got lost in the sea of complexity. Along the way, they realized call center businesses very difficult to scale, and they hired a guy named Raj Singh. Raj and his brother were the founders of Concur. and they created the same level of innovation and transformation in the travel industry. They now want to bring that to Accolade in the healthcare market. They've raised a total of $220 million, and their focus is to create a lot of different software and tools to automate all the complexities that consumers experience in trying to navigate different healthcare options. From what do you select, what providers do you go see, how do you interpret and navigate those EOBs, and how do you really kind of be more empowered as a consumer to make smarter, more informed decisions. And I think we need things like that, because as we push forward into the triangle of the payer, the providers, and the patients need more resources to make more effective decisions. And I think that's really where it starts, on really driving efficiencies and improving some of the challenges that we've experienced in healthcare over the years.
I think I smell a deal with Amazon coming on with that one.
Yeah, well,
Seems like a
one of
good
the things
fit.
I was going to mention is the Chief Operating Officer of Accolade is now the Chief Operating Officer, Jack Stoddard, Chief Operating Officer of the new Amazon effort.
Oh, that's even better. I got to get in the middle of that deal. Yeah.
There may be some connectivity there and some transparency. We'll see.
That's good. I'm going to switch to market dynamics next, and I'm going to hit Mike up with his crystal ball on the next hot space.
The next hot space in healthcare?
Yep. Yeah, it has to be healthcare. It's the whole thing today.
I'm saying, some other ideas.
No gambling, no nothing, just healthcare.
You know, it's a really good question. And here's how I would put it. I do think that remote kind of monitoring, telehealth, kind of that whole idea of leveraging technology to materially improve the productivity of our limited number of healthcare providers. And I don't mean just physicians, I mean sort of the whole healthcare ecosystem. As the prior panel noted, I mean, we're going to have increased shortages there. I do think that's where the opportunities are. Have I seen one that sort of I'm absolutely convinced works? No, I will tell you, I think biotelemetry, just again, highly biased there, but I do think it has proven a remote monitoring model that works at scale for hundreds and hundreds of thousands of patients. And it has demonstrated it can be done profitably. I still think there's opportunities in the telehealth area to sort of create that same type of evolution. But I do think that's an area where we've looked and are looking for those companies that can truly use technology to materially increase productivity, which is essentially what we have to solve for in the coming challenges of healthcare, of more people and less providers.
Ron, what about Varsity and you and what you guys are talking about in terms of the next space you guys want to really enter your thesis?
Well, I won't call it the next one because we just invested in it. But, you know, I think it's taking advantage of some of the things that are happening that are huge impacts, mega trends, if you want to call them that, in the industry. So we just invested in a company called Ideal Option out of Washington State, which is a MAT OBOT company. We heard presentations yesterday about that really impressive group in Minnesota that is doing MAT OBOT. We've invested in this company that has 50 centers around the Pacific Northwest. And as they open an office, it fills within 6 to 8 weeks.
Wow.
And so, you know, catching, I think, a huge epidemic, #1 public health issue in the country that's been identified that way. I mean, I actually think there are a couple others that are #1, but, you know, the #1 getting attention today, I think the opioid epidemic is a tremendous opportunity, and we're excited about it because it's a mission-driven company, and yet there's a lot of cash flow that happens. So if you can save lives and make money at the same time, that's what we're all about. The one other area that I think is it's interesting is we've heard about important areas in healthcare. This is actually a word I haven't heard yet mentioned in this conference, and that's obesity. And I would say, you know, that may be as big a public health issue as opioid. It's one of the major, you know, other than aging, it's the major cause of chronic disease in the country. And there's, you know, we all age, as I'm finding out. So, you can't stop the aging process, but you actually can and interrupt and have a big impact on obesity. And so I think obesity as an area to focus on in the future is a really exciting area.
Yeah, go.
So I just wanted to dovetail off of what Mike had said in terms of the next big thing in healthcare, probably from my vantage point. So I'm the Chief Financial Officer at LifeStance. We are the largest behavioral health, mental health provider group in the country. We've been quietly rolling up the space, and we've also been launching a bunch of new office de novo opportunities. And one of the things I'm probably most excited about in the broader behavioral health space, there's a massive shortage of psychiatrists, and psychiatrists that specialize in different areas across the country. Very, very difficult to get in. In some parts of the country, it'll take up to a month to see a psychiatrist. And what we're trying to do is we're trying to solve the supply problem, and we're trying to really bolster the opportunity to aggregate the supply and then explore these different telehealth models where we can bring that supply to other parts of the country. And I think it'll take a little bit of time, but there's opportunities to bring, and this is probably an incredibly overused level of innovation, but to bring the Uber concept of demand aggregation and management and supply aggregation and management, and to bring that into the mental health and behavioral health space. So I'm really excited about watching closely the telehealth models as they continue to get acceptance in the marketplace. Patients become more comfortable augmenting that. I don't think it's a total replacement for your care, but it's a great augmentation. And then in places where you've got incredible shortage of qualified practitioners, you'll be able to kind of distribute that demand over to where supply, or distribute that supply over to where demand is needed. And then it starts to bring kind of really interesting opportunities in pricing models. How you think about a provider that's a low-cost provider, maybe in the Midwest, that needs to serve the needs in the Northeast, which is probably one of the most expensive care management areas. So you can start thinking about how you redistribute that in a much more effective and efficient manner. So at LifeStance, we're thinking about that quite actively. We're on the services side, so we're really hoping that there's a lot of innovation companies out there that we can partner with that will help advance the effort that we're undertaking.
This is a really cool company, definitely worth a Google. So check them out. Great management team, great investors. I'm jealous. You should come back to investment banking. All right, are you guys ready for another list?
Just before, I want to pile on, speaking of piling on in terms of what, you're talking about, Warren, and that is, and by the way, I started out as a child and adolescent psychiatrist, so, there's more shortage because I'm in PE now, but I actually think that the preferred modality of treatment in behavioral health is going to end up being digital health and telemedicine. It's, if you think about it, psychiatrists, psychologists, social workers don't need to physically examine a patient. It's an interactive process, and if you think about the convenience, the availability, you're talking about the geographic, problems associated with finding appropriate care. I actually think the preferred mode of care in psychiatry, psychology, social work is going to be telemedicine. So I think the whole treatment paradigm is about to shift, and you're going to be able to capitalize on it.
Yeah,
but
we hope so too.
I will, Ray, though, and I want to, and I agree with both here. I think it is. However, the concern is there's this huge barrier to, I've called this silliness of state licensure.
Yeah.
And, this sort of belief that if you're licensed and you've practiced as a doctor in Washington State, that you're not good enough to practice in Florida unless you pass another test. Doesn't matter what you've accomplished. And no one seems to be kind of addressing this kind of proprietary nature. In fact, if anything, it seems like we're becoming more entrenched into this we're a collection of 50 groups where you can't sort of come into my backyard. And are you seeing that as you're doing the roll-ups of being able to leverage across state lines?
We haven't had the challenges of having to test take our practitioners, but there's no question there's all kinds of challenges around credentialing and licensing in different states. And we've got a pretty slick and automated process to that, but it still takes time. We've lost some practitioners because it's taken us 6 weeks to credential them. So for 6 weeks, sitting on their hands, not able to see patients is a real problem. So it speaks to the challenges that Mike's bringing up, is there's no question there's rules and regulations that need to get figured out that will start to streamline this and drive a lot more automation and efficiencies.
Just as a comment on that, absolutely right. 30% of the treatment that we do in our opioid company that I was talking about is using telemedicine. And so we actually have a whole team that sits there just getting people licensed in all those different states. And it's an entirely unnecessary bureaucratic hurdle that needs to be done, but because we've automated it, we've got a team that's doing it, we can do it. But I think it's about, I think Washington and the states need to catch up with it, obviously, but I think it's a tremendous opportunity going forward.
Get out your checkbooks, people. There's no public companies, but there's some private ones you can get into. So I promised you another list. I'll give you one, then I'm going to see if I can get Warren to pick a fight with Ron. I'll try to have fun up here. The biggest areas in 2018 of investment: patient empowerment, wellness, which is the fight I'm trying to get picked, biometric data acquisition, that's Mike over there, clinical workflow, administrative workflow, research, personalized health, insurance, population health, whatever that means, and education. There's your list, last one. Warren, what are your thoughts about wellness? This guy used to be at LifeStance, by the way.
So what Kevin's trying to do is, I was the chief operating officer over at LifeStance, and Ron is the chairman of Aduro, and we're both in wellness. I'd like to think that both companies helped kind of pioneer what wellness was over a decade ago. And I think wellness started out as this really great idea. Healthcare costs rising out of control. How do we, as employers, combat this? Well, let's try and make our employees healthier. And along the way, we'll experience lower healthcare costs. So everybody kind of rushed into the market, led by benefit consultants that said, oh yeah, we need to run all these RFPs. We need to look at all these wellness companies, and we need to determine what's right for us, and we need to really focus on that ROI. The problem is, this is a very complex problem that's trying to be solved, and it's not going to get solved in one silver bullet. So there was a lot of pressure put on wellness companies to perform and deliver this type of ROI. When the ROI wasn't being immediately realized, there started to be a lot of questions being asked about, well, is wellness really an effective way to drive healthcare costs down? And so at LifeStance, we started to evolve our thinking. We started to think wellness is a small little component of the overall big picture. We wanted to really focus on engagement. And engagement meant your total well-being along with a lot of other things. And so as the wellness markets, I think they're still valid and there's opportunity there, but I look at them now as more of a feature, part of a broader set of offerings that will start to drive value. And so at LifeStance, we were really big on evolving wellness, and we went around saying wellness is dead. We need to think bigger. We need to think about what wellness can really evolve into. And for us, it was engagement, how to make your employees happy, healthy, and engaged in what they do will drive down your healthcare costs and will increase productivity. Productivity is really what you should be focused on as an employer, and health is one component of that. So that's kind of my general thinking of kind of wellness as a individual category. I think if you're investing in a tool that does wellness, you're probably not going to do very well. But if you think about the bigger picture of what that tool can evolve into, I think that's where the opportunities lie.
And so Kevin is trying to stimulate a fight here.
It's not going to happen.
No, I'll throw out some things. So, I'm jokingly say wellness is dead only if you don't know how to do it. So, at Aduro, I think wellness, well-being, continues to be primarily focused on services rather than technology. And I actually think there's a tremendous continuing growth opportunity in the area of well-being if done right. But I would agree with Warren that wellness is really just one narrow component of an overall offering that, like Accolade is trying to do and others are trying to do. That if you see wellness as a silo, you're in a lot of trouble. If you see wellness as part of engagement, part of overall health, part of population health, I ran a company, Excellere, many years ago that was a population health company. And there's not a healthcare company today that doesn't claim it's a population health company. So I think the word population health has been badly abused, but the concept of population health, where you take your population and divide it into subpopulations, some of them being well, figure out how to best engage those patients. I think there continues to be a tremendous opportunity in population health.
Well, I happen to know a thing or two about Aduro's growth characteristics in 2018, and they're killing it. So congratulations, Ron. Nice job there.
Thank you.
So when we were preparing for this, Mike came up, as he usually does, with a pretty interesting question. He said, the regulatory environment has caused a bunch of notable failures with Google, Microsoft, Amazon trying to enter the market and saying, don't know that, got to pull back. Mike, can you talk a little bit about that and when you think they're going to figure it out and what it's going to take?
Yeah, no, it's a good point, and I'll relate an interesting comment. I was sitting at a conference actually here earlier this year, and there was the CMO of Google, CMO, Chief Medical Officer of Amazon, and the CMO of Microsoft, who they had hired. And they were on a panel and discussion, and I was sitting next to me, was actually a physician, and he turned to me, and we had known each other. He just really said, hiring a CMO doesn't make you a healthcare company. They're going to soon find out it's a lot more complicated than that. And I think you saw it. You saw Amazon sort of make the first try to entry into pharmaceutical distribution to hospitals and have to kind of pull back from that. One of the challenges that I said earlier is I think the antiquated 1990s era regulations, both that forces it into the states and has this sort of disjointed set of regulations at the federal level, are stifling innovation and enhancement healthcare. Healthcare could be better. Now, does that mean Google can enter it? I think it's going to take a while. One, because they're playing in an environment where there's very few rules. Even the rules, something as simple as sort of privacy or protection of data. If you're a Google or a Facebook, there's really no rules that kind of held your feet to the fire on that like there is in healthcare. So I think they're going to find it a lot more complicated to enter into healthcare and to kind of achieve sort of what they've achieved outside of healthcare in this highly regulated environment.
Healthcare is tough. Our one of the smartest people in the world, and if you don't believe it, ask him, President Trump, felt like he could completely change healthcare. And then he says, I've been finding out healthcare is kind of complicated.
Yeah.
So, I do think it's extremely complicated. I think, Google's and Microsoft and Apple's efforts so far have really been very, very small efforts, and so they've stubbed their toe because they made small investments. I actually think all three of those companies are going to come in a big way after they figure it out, and as smaller companies disrupt healthcare, I think those consumer-oriented companies are really going to pile on. And I think, when I think about 10 years from now, Indu was talking about it, I think those are going to be companies whose names are going to be very actively involved in healthcare.
Yeah, I do
and
too.
I think it's going to be a welcome change.
What do you guys think of the petri dish that we've got going on with Amazon, Berkshire, and Chase? They're trying to make their own little ecosystem. And there are other companies out there, notably Vera Health is in the audience here. Iora Health is there. They've been mentioned a couple times during this conference. It's the right new model.
Do I think they're going to ultimately be successful? The cynic in me kind of says the first mover there tends to be one that fails. And I drop kind of one word there is Netscape. It's the second and the third ones that kind of watch the first failures that figure out how to be successful. But having said that, this idea of sort of we've got to make changes is important. Unfortunately, how they're looking at it sort of just in their microcosm, I think ignores some of the more fundamental challenges we have in healthcare that they're not going to be able to address unless it becomes sort of a public-private partnership. We've got to fix some things in the political sphere in order to move forward in healthcare. It's not going to be just something to be done outside of the government.
So I want to switch gears real quick because we're
Well,
falling behind.
I wanted
you want
to say something
about
that.
Okay, go ahead.
So one of the things I'd say of that triumvirate, Amazon is the one really to be watching, because I think Amazon, once again, is a consumer-oriented company. The other two partners are really just there for their employees. So they're kind of piling on, I think, to what Amazon is going to do. So I think Amazon with a consumer focus, with Jeff Bezos's willingness to take on very difficult industries and actually lose money. He's not worried about losing money. He's really interested in disrupting and a long-term investment. And yet, I think it remains to be seen whether this triumvirate is really a part of what Amazon is going to do, or whether it's just a large employer coalition. I think the more exciting thing to watch in this next year will be CVS's involvement with Aetna, because those are both healthcare companies, both very, very sophisticated. Their interest in taking their learnings from their pharmacies and introducing a real affinity program into the Aetna market, I think that's actually going to be have more an impact on healthcare in the next 3 years than the Amazon one. But, what remains to be seen.
I'd love to hear the number of Amazon mentions this year at this conference versus last year. I'm willing to bet it's double. And that's a pretty scary stat to guess at. Just switching a little gears, all three of you guys have been both investors and operators, and that's part of why I asked you to come up here and do this panel. And, Warren, I'll ask you this question really. What do you think the biggest disconnect is between investors and operators? Because you've done so many deals and you've seen operators, and there's this perspective that's a real difference.
Yeah, I'll maybe just start out by saying there can be a disconnect, but there also can be a very harmonious relationship if you've got the right capital backer that's aligned with your vision as an operator and the market opportunity. I think some of the general misconnects or disconnects that happen in companies that I've seen and advised and been a part of, you have a valuation issue. Investors always want to get in at the absolute lowest price, and they want to get out at the very, very highest price. So you'll struggle a little bit as an operator attracting capital at an alignment around value. I think time horizon is also potentially a little different. You generally have a 3 to 5 year time frame, and investors are really looking at how do they generate their returns, and they might have a lot of pressure on them from their LPs to do so. In the present company that I'm at right now, I've had the good fortune of working with these capital backers in prior companies, so we're very, very much aligned. I think the biggest thing that we debate right now is when to think about the exit. They want to create a huge return because they're looking to deploy big, big dollars. We as management see a pretty good return in our very near future. So we're going to kind of battle maybe a little bit around the time frame of which we go out in the market. We think the opportunity is ripe. I think Ron had mentioned this around scary valuations right now that won't persist indefinitely in the future. Well, as a banker, you could execute, I used to tell my clients this all the time, you could go execute the lights out over the next few years, but if the macro factors have fundamentally changed, you could actually be destroying value, shareholder value, by prolonging your decision to look for that exit. So I think those are some of the things that we kind of wrestle with. I think the other thing that I've kind of also seen in a past company is how you think about growth versus profitability. And I know as an operator, we want to get big. We want to move the needle. We want to go after creating big levels of value. The investors have a managed view of risk and say, okay, that's fine until you run out of money, and then you're going to be in big trouble. So there's been some kind of differences around how much investments to drive versus growth, and then when to start to think about the bottom line.
Mike and Ron, related to this, and I know you both really work hard on the vision of success, post-transaction. What does it look like? And maybe, Mike, we can start with you, and Ron, if you would finish up on that one. Just what does it look like to work with a private equity fund? What changes do you see in the operations of a company? Mm-hmm. Really dig in on the backgrounds you both have as operators, as successful CEOs, COOs, and what you've learned in your experience with working with private equity.
No, it's a good question. And from our perspective, and especially a lot of the equity from that sort of are in our space, is this is the first institutional money that's come into the operation. And so oftentimes it's a change in the way the CEO and the management team have done business. So one of the things, I find very useful and is a clear sort of time and dedication to understanding the needs of each other. And one of those is that for the private equity investors to understand sort of the needs of operations, which is to have a clear set of priorities, a clear understanding of what the focus is. Changing priorities is the death of operations, because you run side to side, you run fire to fire, you tend to be reactive, and you lose a lot of efficiency. And coming up with, here's the new shiny object doesn't help an operation team. But having a clear sort of understanding of what's necessary for operations. But likewise, operators, one of the things that often is misunderstood is the importance of data to the investors. And I use the phrase, when I meet with operation teams, is data is oxygen to investors. And if you start cutting that off, or you don't give it in time, or it doesn't come as clearly, they're going to start choking. And that's when people start flailing around and you get a lot of disconnection. So thinking about the needs of each group, aligning those needs so that each kind of gets the information they need, operations get clear priorities, investors get the data and information they need to make decisions. And then the final one, I even had put this in a sign one time, I put, one, reality is not a spreadsheet, and number two, no spreadsheet survives contact with operations.
Ron, how about yourself? Differences between vision of success with...
Yeah, so, just going back to what Warren is saying, if you look at most private equity companies, they're focused on growth and profitability. Those are the two things. And so I would say the private equity companies who come in and are unsophisticated about healthcare, they're just focused on those two metrics. Back to what you were saying, we are a smaller to mid-market investment private equity company, and so we're often the first institutional money. And I think getting management to shift from instinct-driven decision-making to data-driven decision-making is really a challenge. And yet on the private equity side, private equity does everything from spreadsheets. Right. And so you have business school graduates who think they can run the company from a spreadsheet. And they're the delicate balance between instinctive decisions that most healthcare operators do, especially on the smaller side, and data-driven ones, which are done on the private equity side, aligning those two to make sure you get the right decision being made is one of the big challenges.
This, folks, is why you want these guys on your board, because they recognize that disconnect and they recognize it well. Great. Last question, and then we'll open it up to the audience for questions. So there was recently a fairly scathing article in the New York Times about dermatology, and turns out that there are 34 dermatology platform companies out in the space, and the article went on to say that they didn't like some of the changes that private equity was making in those dermatology practices, thinking it was diminishing the quality of the care, and they were only after, profits. And so that's a negative spin on what private equity is potentially doing in the space of outpatient services. How do you think private equity can evolve healthcare, and how do you, and particularly Warren, in your case, you're building out all of these new centers, but I'd love to just get a quick snippet from the three of you guys on your vision of the best use of private equity in healthcare.
Just quickly on my end, and I can speak more from the standpoint of what we're doing at LifeStance. We're utilizing private equity. They've got lots of resources and lots of great capital and experience to aggregate a very, very fragmented market. And we think when there's some more aggregation, we'll then be able to create real innovation and real value that will help drive that. Private equity helps us get there faster in a much more I call it experienced way, where the learning lessons are already plug and play with our partnership around that front. So I see a lot of opportunity.
It's great voiceover. Gets you there faster. Ron, what do you think?
Well, that dermatology example you give is near and dear. I ran a dermatology company, as you know. Varsity is probably the cause of all of the interest and excitement. Well, not all of it, but a lot of the excitement in dermatology, because we were the first private equity company to make a big bet in dermatology and already exit. So, we went from about 12 practices to about 70 practices in 24 months and invested about $60 million and sold it for close to $500 million. And so, I would say a lot of the excitement in dermatology is after seeing those transactions.
Turned out pretty good for you, didn't it? Yeah.
And saying this must be an area to be investing in. But you're right, and private equity is no different probably than many other industries. They're like lemmings. They hear that somebody did well in one area and they all jump on. Back to the issue of that article, I happen to know that the disgruntled authors were people who, had a bad experience. And so, I understand the genesis. And I think if it is from an unsophisticated private equity company trying to drive profitability and growth without making clinically appropriate decisions, private equity is a negative influence in healthcare. So it really is important to have people who know healthcare, who are investing in it not just for the financial returns, but for actually improving outcomes. And one of the things that we say, at Varsity, one of the key assets that we're investing in are providers and practitioners' experiences. We don't want to change clinical practice. What we want to do is we want to make it more efficient and help with the growth of it. So people who want to come in and influence clinical practice have no business investing in healthcare.
Couldn't agree more. Mike, do you want to take a whack at that, or do you want to open up for questions?
Yeah, so my final comment is, and I agree with both, is look, private equity are run by humans, and like anyone else, there's always a fear that you're going to miss out on something. So you see things like the dermatology is everyone jumped to me because there was a fear we're going to miss out if we don't do that. But I do think when private equity does what it should, which is find those private companies, find those opportunities that it can accelerate both with its talent and with its capital, that is where success is driven. It's those early investments, whether it's in urgent care, whether it's in early dermatology. That's where private equity really fits in to sort of our large investment ecosystem, because it does it outside the purview of the public company financials, outside of the bank purview where you're not worrying about is the loan going to be paid back. It provides, I really think, the best incubator for those companies that are truly innovative, that have created a value that can drive growth.
I think with that, we have time for probably a question or two.
Hi, thanks, gentlemen. I really appreciate your talk. So to start with, to my knowledge, Moss Adams is not looking for a private equity investor right now, so just to be clear. But let's say if there is a folk or two in the room that are thinking, a couple years from now, having an investor to grow would be great. Is there a big ticket item that you'd share with them that one is going to want you to sit down and write a check for 14 times EBITDA, and one's going to want you to turn and run out the door?
Wow. I don't know that I could give you a hard answer other than here's sort of what I look at when we look at a company. We're interested in companies that have developed a growth model, because ultimately growth, but have done it in a way that is using technology or innovation to create a competitive opportunity that's different than anyone else is doing, and is doing it in a way that creates true value. I'm not really interested in companies that are sort of exploiting a temporary inefficiency in the market, or a temporary that, hey, if we invest here, the payroll rates are really high, let's just grab that and leave. I'm interested in companies that can create something that's truly valuable, and most of the time that is using technology to create that competitive advantage that positions you better for growth than the others. Does that answer your question?
I think maybe one more question, Brian. I'm looking at you. One more question, if we've got one out there. Shy audience, everybody's tired. It was the cocktail dress that got you guys last night, wasn't it? That was pretty fun. All right.
One of the things I would say, just in reaction to that, the triple aim that is important for physicians is also important, as far as I'm concerned, from private equity.
Yeah.
We actually use that triple aim as a metric on companies that we're going to invest in. So if we can improve care, if we can make care more efficient, if we can lower the cost, if we can improve the patient experience, that's where we want to invest.
Great. Well, thank you all for your attention this morning, and we'll see you again next year, I hope.